may be smaller than the repair bill, even when the damage is covered. The gap can come from depreciation, your deductible, or an actual cash value payout. That is why the thumbnail says you pay the gap. The claim may respond, but the first check may not finish the repair. If you miss the ACV versus replacement cost line, the repair invoice can be bigger than the payout. Start with the line most homeowners skip: actual cash value versus replacement cost. Actual cash value, or ACV, is the mechanism that triggers the gap. ACV reimburses you for the depreciated value of your roof at the time of loss, rather than what it costs to replace it today. This depreciation accounts for age, wear, and tear. For example, imagine a 10-year-old roof with a 20-year expected lifespan. An adjuster might decide it is 50% depreciated. If a new roof costs $15,000, you are only looking at $7,500 in coverage before your deductible is even applied. The overlooked detail here is that the insurance company is using a formula to value your roof as a used asset. You are essentially paying for the gap between a decade-old roof's value and the market rate for brand new materials. You must check your policy for the specific definition of ACV, as some states and carriers use different calculation methods that further reduce the payout. Replacement cost value, or RCV, is often marketed as the superior option because it pays the full cost to replace the roof with an equivalent, without the immediate penalty of depreciation. While RCV policies carry higher premiums, they are designed to bridge the gap that ACV leaves wide open. However, do not mistake a premium RCV policy for a blank check. Even with RCV, you are often required to pay the deductible upfront, and the insurance company will typically hold back the depreciation amount until you provide proof of completion. This is a common misunderstood mechanism. You receive a partial payment first, and the remaining funds are released only after the contractor sends the final invoice. If you do not have the cash to cover the full project cost while waiting for that final release, you could face significant financial strain during the construction phase of your home repair. A growing trend in the industry involves insurers attaching a roof payment schedule, or RPS, to policies that were previously standard RCV. An RPS effectively turns an RCV policy into a sliding scale, where the payout is capped based on the age of the roof and the material type. This is a critical document line to check in your policy language. Even if you think you have full replacement coverage, the RPS can slash that coverage significantly if your roof is over a certain age. It essentially functions like an ACV policy in disguise, limiting your payout regardless of the actual cost of materials or labor. If you see terms like schedule of payments or roof age multiplier in your policy documents, you are looking at a potential trap. You must verify if your policy includes an RPS clause, as this can turn a simple storm damage claim into an unexpected bill. Your deductible is the constant in this equation, but it is often the most overlooked factor in the total cost of a roof replacement. Whether you have ACV or RCV, the deductible is subtracted from the total payout. If your roof claim is $15,000 and your deductible is $2,000, you are responsible for that $2,000 before the insurance company pays a dime. The real money loss scenario happens when homeowners underestimate the total project scope, including diagnostic fees, permit costs, and waste removal. These secondary costs often push the total project invoice well above the initial insurance estimate. You should ask your contractor for a line-by-line estimate that matches the insurance company's scope of loss. If the contractor's numbers differ from the adjuster's, you are the one responsible for the difference, which can easily amount to thousands of dollars in unexpected expenses. The initial adjuster's estimate is rarely the final word on what the repair will cost. Adjusters use software to estimate costs based on regional averages, but these averages can be outdated or fail to account for the specific complexities of your roof. For example, if your roof has steep pitches, difficult access, or requires premium materials, the adjuster's estimate might be significantly lower than what a qualified local contractor needs to charge. The misunderstood mechanism here is that the adjuster's estimate is just a starting point for negotiation. Many homeowners accept the first number provided without checking if it covers the actual labor and material costs. You should compare the adjuster's estimate against your own independent contractor bids. Documentation is your primary defense against a lowball insurance payout. If you are going through a claim, keep a meticulous record of every communication, every photo of the damage, and every estimate you receive from a contractor. An overlooked detail is that insurance companies often rely on their own internal databases, which may not reflect current market inflation for materials like shingles or plywood. If you have an RCV policy, you are entitled to the cost of replacing the roof with new, equivalent materials. If the adjuster insists on using lower-grade materials, you must challenge that based on your policy terms. Providing clear, documented evidence of the necessary costs can be the difference between a successful claim and a significant financial loss. Never sign off on a final settlement until you are absolutely certain the amount covers the full scope of the required repairs. If you receive a payout that seems insufficient, you are not necessarily stuck with it. You have the right to request a re-inspection or provide a supplemental claim with additional evidence. The immediate viewer action is to contact your insurance agent and ask for a detailed explanation of how the payout was calculated, specifically regarding depreciation and any applicable schedules. If the math does not add up, you can request an appraisal or consult with a public adjuster, although you should weigh the costs and benefits of those options carefully. You should always be prepared to advocate for the coverage you are paying for, especially when the discrepancy between the payout and the actual repair cost is substantial. The most effective way to avoid these traps is to manage your policy before a storm ever hits. Review your declarations page annually, not just when you renew. Look specifically for the terms ACV or RCV and check if there are any added clauses like an RPS or actual cash value endorsement. These terms dictate your financial future in the event of a claim. If you find your current policy is heavy on restrictions, talk to your agent about the cost of upgrading to a true replacement cost policy without restrictive schedules. While the premiums may be slightly higher, the peace of mind knowing you are protected against a massive out-of-pocket gap is worth the investment. Being proactive about your coverage is the only way to ensure that when a disaster strikes, your insurance company actually does what you pay them to do: protect your home.